in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast Markets. This edition of the Moving Iron Podcast is brought to you by Dawsontire and Wheel, your premier ag tire and wheel provider in North America, helping people grow. TractorZoom delivering insights, and Dryshod Boots, the official work boot of the Moving Iron Podcast. Like normal, I've got Shawn Hacket here from Hackett Financial, and we're going to talk about some markets and stuff we see going on out there. And Shawn, there is plenty of stuff developing in South America leading into this La Nina thing. I'll tell you what, the La Nina situation is not letting up down there, and this is the first week in a while that the Brazilian USDA version of the USDA did not retract some bushels or something like that off the crop they have. So the market's kind of fluctuated a little bit this week. We're starting to see that volatility start to come back in, not that upward climb that we see, but it really looks like there's the situation is getting a little more serious than they want to admit.
They're slow. They're always conservative. They always like to wait for January, because once you get to January, the damage kind of starts to become permanent, and then they can start to feel that they can quantify it. And in December, it's still a little early. There still could be recovery. December, January are the rainiest months of the year. So usually the USDA hesitates to make any adjustments, even though they probably should, until they get into January. So January would be the month where I would start to think, the USDA report in January and February, they'll probably start to make more serious adjustments downward. They were resisted in this week's report because that's just the way they do it. They just prefer to kick the can down one more month and just make sure that the crop's under duress and that they can have cover for that. So the markets didn't really get what they wanted this week. They didn't really get the kind of knockdowns in U.S. supplies and in the crop in South America. And so they went into the report up. And as you know, they kind of ended, at least corn and soybeans ended flat to down after being up. And so, we're just kind of in pause mode right now. I think everyone's in pause mode. It's a year end. December, speculators are squaring positions. We're getting a little spotty rain down there. It's just markets are struggling to find a reason why they should buy the markets here into Christmas time. And so it's just a period. You know what? I'm going away. I'm going to be on holiday. Let's just take some positions off and let's get back into January. We'll take another look at it. And that's kind of typical, Casey. It's a typically quiet period unless there's something really going on. And I don't see it right now.
Right.
I don't see it.
Yeah. Yeah, it's fairly quiet right now. A lot of things in limbo.
Limbo.
Yeah, we start looking at we kind of know who the president's going to be, but we're not for sure. We kind of have a vaccine that's ready to go out, but we're not for sure. There's all kinds of things that are fluctuating out there that have a big effect on the marketplace.
The market thinks stimulus is coming, but not exactly sure.
Right.
There's a lot of this going on right now, and it's just the holidays. I would just say, it's a crazy year. We're all exhausted.
Yeah.
Goodbye 2020. I think everyone's just wants to go away for the next few weeks and forget about it all. Yeah.
The best thing about 2020 is it's almost over. That's
it's almost over.
Yeah.
I agree with that.
Yeah. All right. So back again to some drought concerns in the wheat market. Russia here is now, I'm reading an article here that they are considering a 2,000 ruble per metric ton export tax on wheat leaving the country. So that's a big development when you start looking at one of the world's largest wheat producer, and they start saying, like, we're going to pump the brakes on our exports.
Well, prices got very, very high.
Right.
The ruble's been sort of weak, and so the prices got very high there. And, the domestic market is kind of putting pressure on them and saying, hey, look, you keep exporting this wheat out, these prices are going to continue to escalate. So this is not good for us. And then, of course, everyone knows it's the worst rated Russian wheat crop in 30 years.
Right.
And it does not look like to us that dry weather is going to go away. In fact, we think it's going to continue into the spring. And of course, we're concerned that the crop could have a winter kill event sometime here in January. We think there's conditions are getting more ripe for that, and so they just need to be careful. They had a great crop last year, but they certainly need to keep some wheat at home just in case this turns out to be a disaster. They don't want to sell all their wheat and then find out they don't have a wheat crop next year and get themselves into more trouble. So they're taking what I would consider to be a rational move, but it is a big move for the largest exporter in the world. So
yep, yeah, I've been the Brexit thing. It keeps popping up, and I haven't talked about it for a while, but that is from a world economy standpoint and what it'll do to markets and those kind of things. There is they still haven't got that deal done yet, and they're still going back and forth on it, and they're still up. They just keep kind of cool. We didn't get it done this week. Let's just push it out another 3 months, and then we'll kind of keep going. Sooner or later they're going to be just like either you're in or you're out, and it's going to have that hard break that everyone's so scared of. What's your thoughts on that as you kind of look around it and the effect it's going to have and is having on the marketplace?
Well, the biggest impact would be if it ultimately turns out to be a hard break, which it looks like eventually will be a hard break. Yeah. It would be temporarily strong the U.S. dollar, because you'd have a bunch of scared traders and capital out there that will want to flood to a safe currency. Mm-hmm. And if Brexit blows up and you get a euro concern, then money's going to leave the euro and it's going to look for safe harbors in the U.S. dollar short term. So I could see that triggering some kind of a bear market rally in the U.S. dollar into year end, into January, and on the margin, that would just push some speculators out of the U.S. traded markets and give that correction more steam that we've been talking about might be likely here, especially at a time when the markets are less active and the speculators want to actually lighten up positions into the year end. So that's what I see. I think it could be a strong dollar rally potential to give the markets a nudge to the downside short term. That would be the biggest impact that we see. And it would offer a buying opportunity. Quite frankly, we're hoping it happens. We want end users, we want our livestock producers to get a chance to buy feed, and and some farmers have made sales to get a chance to play the other side with protecting those sales. So we're not that we wish lower prices for U.S. ag, but we actually are hoping we get a little more of a setback here, because we want both sides to win here, and the buy side has obviously been on the wrong side since August, right? And we hope they get a shot to buy a break here.
Right.
So
on. Yeah. It's a soap opera almost to watch that thing unfold. It's crazy.
It is crazy. Yeah. It's insane, but that's the world we live in right now.
Yep.
So.
Yep. All right. So Chinese demand is something we talk about here a lot. I've read several articles predicting next year to be anywhere from, I've heard 15 to 40% decline in U.S. exports to China as far as hogs go. And we're kind of starting to see that a little bit. There's a lot of pressure on lean hogs right now when you start looking at pricing and what you see there. So what are your thoughts on that? And where do you see that particular pork market going?
Yeah, we're concerned. We're concerned about the hog market in the U.S. We've had this massive demand for the last 18 months. It's allowed the U.S. to get out of an oversupply situation that we were in, and see some better prices, some profitable prices. But they're going to pull back. Doesn't mean they won't buy. Actually, we still think they'll be historically pretty good buyers, but compared to where they were buying, they're going to back way off. Where's all that supply going to go? Who's going to? We were on the conversation before about the used equipment market. Who's going to buy all this extra pork supply if they back away? And there's always a buyer at a certain price. We just don't think it'll be at this price.
Yeah.
Maybe at 50 cents, maybe at 40 cents, there'll be a buyer. we don't think there'll be a buyer at 70 cents. I mean, we just think it's a price problem, and the U.S. hog market's got a supply-demand problem, especially in the first half of the year. Now, maybe if we get the vaccines going and the global economy really opens up again, and we get some better economic activity and better demand, the second half of the year could be better. But we don't see that happening in the first half, and so we really worry about an air pocket here on U.S. demand for pork, especially from China. And so, we're in our smart money algorithm that we follow is, the smart money's betting bearishly on the hog market right now when they were betting bullishly in the summertime. So we'd be cautious here. We think if you're in a hog business, boy, we sure would want to get our first half supplies locked up here on the price side. We just think that's a good thing to do. We just want to leave that open to the downside. We just think it could get pretty ugly here potentially, and we think there's no reason for a hog producer to not get their first half prices locked in right now.
Right. Okay. So on the flip side, on the beef market, the box beef prices have been coming down dramatically. I mean, it's just been watching that over the week here, the last couple of weeks, and just watching that box beef price keep coming down, which then affects the cash prices as well, as you see out there on fats and feeders. So I guess as you look at those. That cattle marketplace where we saw an uptick in price for a while, now we're starting to see that retraction a little bit. What's your thoughts there? Is that, again, all kind of coming back to what the economy is doing?
Well, look, the majority of demand, despite the fact that we've had some good exports, China finally was buying U.S. beef for the first time in 10 years and all that sort of thing. The predominant demand factor is domestic demand for beef. And as much as the vaccine has brought us a lot of optimism, based upon what I'm looking at the announcements like everybody else, but it doesn't look like the rollout of the vaccine will really allow for a major uptick in the U.S. economy until probably later in the second quarter. So the first quarter looks difficult. The current demand looks difficult. I mean, I see California closing down. I see New York locking down. I see more areas locking down. I see more restrictions. That's not good for beef demand. It's not good for beef demand. And so the box beef price is telling you that. On the flip side, though, we got a very friendly cattle on feed report that showed that our cattle on feed is, way down from what it was expected to be. And that's going to mean that there'll be less animals available for sale in the first half. So that helps mitigate it a little bit. The other thing that I would talk about is that, we usually import a lot of Australian beef for hamburger and the lower end of the meat market. And because of their epic drought that they had for the last couple of years, and because of the massive herd liquidation that occurred there, they're in massive herd rebuilding mode there, and they're retaining all these animals, and the price of cattle in Australia is going through the roof. So we're getting a lot less supply from Australia that we would normally be getting. That's also supportive to the market. So as much as I'm worried about demand, Casey, it really is a mix. It's a mixed picture. It's not. I wouldn't call it a bearish picture. I wouldn't call it a bullish picture. It's kind of a muddled picture. But I think the lack of imported beef from Australia and the lower cattle on feed numbers probably in aggregate that the U.S. demand will be good enough that it probably will allow the cattle market to kind of grind. I mean, slowly grind higher. Into spring, which is typically a seasonal up period. But I wouldn't be looking for any fireworks here. I think it's going to be a real 2 steps forward, 1.5 steps back kind of market. Really not terribly exciting. But we're not as bearish on cattle as we are on hogs. We think cattle can kind of meander higher, but once again, wouldn't be looking for anything dramatic here. So,
2 more things I want to hit on, and then we'll wrap it up here. One is you've written a lot of your Hackett financial commodity reports out here lately on coffee, and people listen to this that are in the corn and beans and cattle and stuff like that are wondering why are we talking about coffee? But coffee is one of those things that it is a big indicator that leads into a lot of different stuff. So talk about that coffee market for a minute.
Well, the reason why coffee is important is because it's one of the largest exported markets in Brazil. Oftentimes, and coffee is one of the most sensitive markets to the Brazilian real. I would argue, it is it is one of the best measures of the coffee market. Oftentimes will react either up or down before the real reacts up or down. And so if the coffee price is starting to rally, there's other factors, there's weather, there's other things, but oftentimes, and it means that the Brazilian real is getting ready to strengthen against the U.S. dollar, which is very, very bullish for U.S. ag prices, U.S. grain prices. And so we watch it not only because we're interested in coffee and we have a lot of customers that are interested in coffee, but it's also a very, very good measure for the Brazilian real. And if you've been looking at the chart of the Brazilian real, we spent a lot of time between 17 and 18, and all of a sudden we've had this surge to 20 cents mark. And if we break above 20 on the Brazilian real, that would be a breakout. That would be a bullish breakout. That would be a bottoming formation. And you put a correlation chart of the Brazilian real against corn or soybeans, it's very, very high correlation. So we think that the coffee market starting to turn up could be an indication that the Brazilian real, after a long period of bearish action, might finally be ready to turn up. And that could be a really positive, bullish tailwind for the first half of 21 if that proves out. So we would be watching that 20 resistance level for a breakout if it were to occur. It could really set off a different tone for grain markets beyond just weather. It could be we could get a currency related impact here in the first half of the year that we have not had going for us, Casey, in a very long time with the Brazilian real. It's been a negative for a very long time. So it's interesting, that the coffee market is starting to show these bullish signs. Obviously, there's been some dry weather in central Brazil, and there's crop problems that have been surfacing. But coffee has a history of only rallying big time when the real is ready to rally. So it's an interesting market to watch for that reason, especially if you're a grain market. If you're a grain market person, if you're a producer of grain, you should watch coffee because it's a great indicator for the Brazilian real. So
okay, right on. All right, the second thing that I'm haven't had a chance to listen to yet, but I'm going to listen to it today. You have a 20-minute podcast out there talking about the winter kill risks on what we see happening as far as weather change starting in January, where there could be some significantly colder weather than what we've seen in the past out here. I mean, I tell you what, 2 days ago, we're getting some snow today because I don't live in Florida. We get snow. You guys get snow in Florida, Shawn?
Sure.
Do you? Okay.
Well,
sure.
when the ice rinks, do the Zamboni, and they got to jump the ice outside.
Yeah. Is that the snow globe when you shake it? That's the snow you get in Florida?
Yeah, that's the snow. I mean, we play in the snow.
But anyway, so you got this thing coming out, and it's been record warm temperatures here. I mean, I'm talking 2 days ago it was 68 degrees here. I mean, which is highly unlikely for this time of year here. But that being said, it is also 12 degrees outside right now. So,
you recall, Casey, that our forecast at the beginning of the year is that we would have a very warm fall.
Yep. Very true.
A very late start to the winter.
Yep.
That's what a natural climate cycle algorithm is projecting, and we were calling for a very good harvest season. Bearish natural gas prices because of this warm weather, and so that is playing out. But we do believe that we're going to have. This is not the big winter year. We're going to have winters. It's going to be short. So I don't want anyone to get this concept that January is going to be like just buried with awful weather. But we do believe we're going to start to get some cooler air intrusions. And so when we're dealing with winter kill risk, we don't need 30 days of cold. We just need, an evening that gets too cold, or 2 evenings that get too cold. And so we think the risks of these cold shots of air to come down into the southern plains or into the Russian, southern wheat belt, we think are increasing. Doesn't mean it will happen for sure, but we looked at a lot of things in that podcast that give us some confidence that we might be increasing the probabilities that we could get a shot or two of those cold air shots into the key winter wheat belts that could cause winter kill risk. And the thing is, this year, because it's been a dry winter, a lot of the winter wheat belt is not covered by snowfall that it normally would be. And because the crop didn't get established very well, and because the crop is in poorly rated condition, it makes it even more vulnerable to a winter kill risk actually doing irreparable damage. And so we would be looking for, late December, in that mid-late January timeframe as a increased risk for either area to possibly get a winter kill threat or a winter kill risk. And of course, at a time when everyone's worried about the crop already, that could really set the wheat market off onto a pretty significant weather spike trade, if it were to occur. So wheat market has corrected, although it rallied here the last couple of days, but it had a pretty good correction. So we're just saying that if you're on the buy side of wheat, if you're someone that needs to buy wheat, or this would look, hedging is risk management. We just think that we would want to be protected to the upside in the month of January with what we're seeing. We think there could be something pretty wild that could happen here, and one would not want to get caught if you need to buy physical cash wheat. Just don't get caught not having some protection to the upside. We think this is a time to be managing that upside risk at this point. So we're sufficiently concerned that we put out a podcast giving everyone plenty of time, meaning weeks of time to prepare and look for corrections and look for opportunities to do this. Because what happens with this kind of thing, Casey, you can't wait for the winter kill threat to be obvious because it's too late to do anything about it because the market's going to take off already. You have to see it coming in advance and make sure you're prepared for it before it actually gets there. So that's a market we'd be paying attention to. So
good stuff, man. Well, Shawn, just like this report, it's a good thing to have those things out there at your fingertips. What's the best way for our listeners here to get a hold of you and ask you these questions that are on their mind?
Well, they can always go to our website at Hackett, Hackett, advisors.com to look at all the things that we have on there. Of course, they can always shoot us an email too, like we did last week with the podcast. If they want to shoot us an email at Shawn, SHAWN, at HackettAdvisors.com and say, they want to see this winter wheat podcast that we did on this winter kill risk, we'd be glad to send it to your listeners. We think it'd be a pretty timely podcast, especially for those that have an interest in the wheat market. So.
Absolutely. Well, good deal, Shawn. Thanks for being on the podcast. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you can find the latest editions of the Moving Iron Podcast. Also, the blog I'm getting ready to put out. That'll be out this weekend. Also, go to movingironllc.com, and you can find the same information there. Where you can find the podcast. You can find all the blogs I've written. You can also find all the information about the Moving Iron Summit that got moved to September 15th through the 18th, Nashville, Tennessee. Same location. Everything's the same. I'll have a new link to book rooms and those kind of things there on the setup page. Shawn will be there. Actually, pretty timely when Shawn's there because we'll be heading into that big time front of that 21 winter fall time frame. So Shawn's speech will be right on point there. So if you're interested in more information about that, check that out or send me an email at movingironpodcast@movingironpodcast.com and I can get you more information about that. So with that, I am Casey Seymour, Shawn Hacket. Let's move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here.